There's lots of influential US data out this week relating to US industry, and I'm joined now by Chief Economist at Markit, Chris Williamson, to get the inside track. Chris, the stats last month were pretty disappointing. Are you expecting a weak picture this month as well?
We are. There may be some bounce back. Obviously, the picture in April was one of a flat reading, the weakest for a year. There may be some small bounce back from that, but I think that will be a technical aberration rather than any indication of what the trend is doing. When you look at other surveys such as the ISM survey, there was a steep fall in May, which I think is a precursor of some worse industrial production numbers to come. I don't think we're over the worst of this slowdown yet, but it still remains to be seen whether things can pick up later in the year.
So what is the general trend of US manufacturing going forward?
Yeah, well, I think global growth probably peaked around the turn of the year. First quarter was really quite strong in many countries. The US was an exception, it was quite weak there, but globally, a very strong manufacturing picture around the world. But we've come down since then in terms of the rate of growth. There's a number of reasons for this. One is that there's a stock cycle factor playing here, whereby companies were simply making more than they could sell in the final quarter of the year and into the beginning of this year. So you're going to see a reversal of that as we move through the summer probably. So there'd be some inventory correction, but that should be temporary and work out of the system by the second half of the year, hopefully.
What are the main challenges? Is it a lack of domestic demand or a general global slowdown?
It's both. Domestic demand remains very weak. It's really holding back GDP growth in the States. But at the same time, there is this global slowdown in trade. Now, we saw very recently China export falling 13% down year on year. Now, that's down from a peak of 45% annual growth last February. So that's a real indication of how global trade flows have slowed. So the US is facing those two factors really, weak domestic demand and global trade flows weakening.
QE2 is coming to an end at the end of this month. Are there any signs of more stimulus by the Fed?
Well, Ben Bernanke's last speech showed that they have really no appetite for extending QE beyond what it is at the moment. So no more stimulus is on the cards at the moment. A lot of people in the markets were disappointed by that. I think really, though, Bernanke, like many others, are expecting growth to pick up in the second half of the year. And if you don't see that happen by September, say, then I really do think there'll be increased calls for more quantitative easing.
But why has the recovery been so slow by the private sector?
Well, when you look at manufacturing, for example, there's a lot of uncertainty around, as we've just been talking about, global trade and so forth. But don't forget also, manufacturers have been really hit by high costs. We've got oil going up in price, many metals hitting record prices earlier in the recovery. They've come down a bit since, but historically they're still very high. So manufacturers are looking to protect their profit margins wherever they can, and that's being through keeping staff costs down, keeping the employment rate down as low as possible.
OK, thank you, Chris. The industrial production numbers and the Empire State Survey come out on Wednesday, and the Philadelphia Fed Survey is out the next day, and you can get the exact time and details by looking at our daily economic calendar. But for now, it's goodbye.